Welcome back to the deep dive. Lots of you have been looking into X-Rite, and we thought it'd be really useful to dig into their latest numbers.
Yeah, the first quarter results for 2025 are out.
Exactly. So we're building on some of the, initial thoughts out there. We've got the official report, some news analysis.
Yeah,
Basically, we're here to unpack it for you.
right. The mission really is to get past just the headline figures and give you a clear, concise view of where X-Rite stands now.
And maybe where they're headed based on this fresh data.
Exactly, like a shortcut to getting properly informed.
Okay, let's jump in. First quarter 2025 versus first quarter 2024. Overall performance seems pretty positive.
Absolutely. Comparing those two periods, there's some encouraging growth. Net income up 16.2%.
16.2, okay.
Yeah, heading RM 49.13 million, up from RM 42.27 million. Earnings per unit EPU also nudged up slightly, 2.44 cent from 2.42 cent.
Okay, marginal increase there.
But, and this is key for investors, the dividend per unit, the DPU, went up quite nicely, 2.5 cent from 2.3 cent.
Right, that's a more significant jump. Almost a 9% increase in the dividend itself.
Exactly. And that signals, well, not just a direct benefit for you as an investor, but suggests the underlying business is doing well. Management feels confident.
Okay, that DPU increase will definitely catch some eyes. What about the top line? Total income, property income.
Both strong. Total trust income up nearly 19%. RM 89.87 million compared to RM 75.54 million last year.
Wow, almost 19%.
Yeah. And net property income, NPI, saw a really substantial increase, 20.4%.
20.4. Okay, even better.
Reaching RM 78.24 million, up from RM 64.97 million.
So what's behind this pretty impressive climb? What fueled it?
Well, the report points to a few key things. Firstly, you've got contributions from properties they bought recently.
New acquisitions kicking in.
Right. Secondly, AXIS Mega Distribution Center Phase 2. They got new tenants in there, so occupancy went up.
Ah, okay.
And thirdly, positive rental reversion.
Meaning they're getting higher rents on renewals.
Exactly. Negotiating better rates as leases come up. So it's a mix of new assets, better performance from existing ones, and good rental negotiations. It paints a picture of proactive management.
Okay, that year-on-year view is helpful for the trend. But let's get a more recent snapshot. End of March 2025 versus, say, end of last year, December 2024. How do the key figures look?
Good question. So as of March 31st, investment properties were valued at RM 5,095 million-ish, just slightly up from RM 5,090 million at year-end.
Okay, slight bump in property value.
But interestingly, total assets actually dipped a little. RM 5,208 million down from RM 5,258 million.
Okay. What about the other side of the balance sheet? Liabilities and unitholders funds.
Liabilities decreased, which is good, down to RM 1,868 million from RM 1,959 million.
Right, paying down some debt.
Seems like it, or maybe just timing of payments. And conversely, total unitholders funds increased, up to RM 3,339 million from RM 3,299 million. So a stronger financial base, more equity relative to debt.
And for those of us tracking the per unit figures,
Right, the net asset value, NAV, per unit before they paid out the income, that rose to RM 1.6528,
okay,
up from RM 1.6409 at the end of 2024. So the underlying value per unit has increased slightly.
and did the number of units change?
Yes, a small increase there too, about 2.02 billion units in circulation, up from 2.01 billion. We can touch on why later.
Okay. Let's circle back to that income distribution you mentioned, the 2.5 cent dividend. What are the details?
So yeah, the proposed first interim payout for 2025 is 2.50 cent per unit. And what's quite striking is that this is 99% of their realized income for the period.
99%. Wow, they're paying out almost everything they earn.
Pretty much. It shows a strong commitment to returning cash to unit holders.
Where's the cash coming from mainly?
Primarily gross rental income, that was about RM 89.5 million, plus a small amount, around RM 0.4 million, from profit income.
Any tax implications for the unit holder?
Yes, they estimate about 0.48 cent per unit of that 2.5 cent will be non-taxable for you.
Good to know. And the key dates. When do people get paid?
Payment date is May 30th, 2025. But you need to be on the books by the closure date, which is May 8th, 2025.
Got it. May 8th to be eligible, paid May 30th.
And just as a reminder, the final payout for 2024, the 1.27 cent, that was paid out back on March 25th this year.
Okay, thanks. Let's shift gears a bit. Operations. The properties themselves. Any changes in the portfolio size?
Nope, still 69 properties as of March 31st. Same as the end of last year.
And occupancy. You mentioned the mega distribution center.
Yeah, the overall picture is really strong. Get this, 58 out of the 69 properties had 100% occupancy during the quarter.
58 at full occupancy. That's impressive.
It really is. Shows strong demand for their spaces.
Did they spend much on upkeep or improvements?
Yes, they invested about RM 4.5 million in property enhancements during Q1.
Okay, so reinvesting back into the portfolio.
Exactly, keeping things modern, attractive to tenants, which ultimately helps maintain that high occupancy and rental income, benefiting you as the investor.
We compared Q1 25 to Q1 24. How does it look compared to the previous quarter, Q4 2024?
Also positive. Property income was up 2.4% compared to Q4 24.
Okay.
Net property income also up 2.4%, but interestingly, non-property expenses fell quite a bit, down 13%.
13% drop in expenses. What caused that?
The report mainly puts it down to lower financing costs during Q1 this year.
Ah, okay. Lower interest payments.
Seems like it. And that drop in costs really helped boost the net income before certain adjustments. That was up 18.6% compared to Q4.
So lower borrowing costs made a big difference quarter on quarter.
Definitely played a key part.
Any action on buying or selling properties, acquisitions, disposals?
Yeah, there are updates. There's that pending acquisition, a storage yard in Bukit Raja, Selangor. That agreement was actually signed back in April 2024 for RM 38.8 million. Still in progress.
Okay, so that one's still cooking. Anything being sold?
Yes, they've got a proposed disposal of the annex in Petaling Jaya, Selangor. That's for RM 24.2 million, and the agreement was signed more recently, February 26th this year.
So actively tweaking the portfolio, selling one, buying another.
Exactly. Asset recycling, trying to optimize the mix.
You mentioned earlier the number of units went up slightly. Why was that?
Yes. That was mainly due to their income distribution reinvestment plan, the IDRP.
Okay, the drip feed.
Right. For the final 2024 dividend, about 10.3 million new units were issued to unit holders who chose to reinvest instead of taking cash. That was completed March 26th.
And the cash they didn't have to pay out because of the IDRP, what did they do with that?
Good question. The net proceeds were about RM 17.25 million. And the report specifically says that money was used for property enhancements.
Ah, so it links back to that RM 4.5 million spending we talked about.
Precisely. It helps fund those improvements without needing new external debt necessarily.
Let's talk about that debt or financing. How does AXIS REIT manage its borrowing?
Okay, so as of March 31st, they had about RM 1,070 million in short-term Islamic financing, things like revolving credits, medium-term notes. That's actually up from RM 815 million at the end of December.
Short-term debt increased. What about long-term?
Long-term financing decreased. It stood at RM 635 million, down from RM 934 million at year-end.
Okay, so a shift from long-term to short-term. Or maybe just paying off a large chunk of long-term.
Could be a bit of both, maybe refinancing or scheduled repayments. The report gives the breakdown.
And how do they manage the risk of profit rates, interest rates changing?
They use hedging instruments specifically, Islamic profit rate swaps or IPRS.
Like an insurance policy against rate hikes.
Sort of, yeah. It helps lock in their borrowing costs to make finances more predictable. They had swaps covering RM 310 million maturing in more than 3 years.
Okay.
And another RM 110 million maturing in less than 1 year. The report gives the fair values, which were slightly negative, reflecting current market conditions for those swaps.
Right. The report also mentions some legal stuff, the Youngnam engineering case. Any updates?
Yes, that's still ongoing. It involves unpaid rent from a former tenant, Youngnam Engineering, and their guarantor. AXIS REIT got a judgment in default against them.
So the court sided with AXIS REIT.
Initially, yes, in getting the default judgment. Now it's about recovery. Youngnam Holdings, the guarantor, is in judicial management in Singapore, and AXIS REIT has filed a claim there.
Okay.
And Youngnam Engineering itself is in liquidation in Malaysia. So AXIS REIT is basically in line with other creditors trying to recover what they're owed. It's progressing through the legal system.
All right. Looking ahead, what's the management's vibe? What are they expecting for the rest of 2025?
They sound pretty optimistic, actually. The manager stated they believe AXIS REIT can maintain its current satisfactory performance for the full year.
Based on what?
Based on the continued performance of the existing portfolio and their strategy of always looking for, good quality income-generating acquisitions.
And their main goals haven't changed?
Nope. Core objectives are the same. Provide you, the unit holder, with stable income distributions and grow the NAV per unit over time by buying quality properties. Steady as she goes, basically.
Okay, now let's try and connect this back to some of the broader discussions we often hear about AXIS REIT, maybe things that have come up elsewhere recently. One point is always the unit price versus the yield. The report mentions a price around RM 1.80. How does that square with the yield?
That's always the balancing act, isn't it? The DPU of 2.5 sen for the quarter implies a certain annualized yield based on that RM 1.80 price. It looks decent on paper,
But
but the market price reflects everything: future growth expectations, interest rate outlook, general sentiment. So while the current yield based on past dividends might be attractive, the RM 1.8 price tells you what the market collectively thinks it's worth today, factoring in all those future unknowns.
right, so a good yield doesn't automatically mean the price will shoot up or it's cheap.
Exactly. Market perception is key.
We also sometimes hear about big players like the EPF maybe buying more shares. Does this report give any hints there?
Not directly, no. These quarterly reports focus on the REIT's operations and financials, not usually the day-to-day trading of its units or who's buying.
But big institutional interest is generally seen as positive.
Generally, yes. It could be seen as a vote of confidence,
Mm-hmm.
but there's specific reasons, we wouldn't find that here. It's just an interesting data point if you see it happening elsewhere.
Okay. What about private placements? Any sign of large new share issues beyond that IDRP?
Not mentioned in this Q1 report, no. The IDRP was the main capital activity involving new units this quarter, and that's more about giving existing unit holders an option to reinvest.
Got it. AXIS REIT's heavy focus is industrial. How's that playing out with e-commerce growth and maybe rising competition in logistics?
Well, their high occupancy, especially that 97% across 58 properties, really shows that their focus on industrial, particularly logistics-related facilities,
Yeah.
is still hitting the sweet spot.
Demand is strong.
Demand seems very strong, yeah. E-commerce growth is definitely a tailwind. Now, longer term, sure, increased competition in building logistics space could pressure rents or occupancy eventually. But right now, for Q1, the performance reflects a really healthy segment for them.
Tenant mix is another factor people watch. We don't get a full tenant list here, but does the high occupancy tell us anything about tenant strength?
Indirectly, maybe. Consistent high occupancy suggests tenants are generally staying put and paying rent, which points towards a reasonably stable base overall.
But we don't know the concentration risk.
Exactly. We can't see from this report how reliant they are on a few very large tenants or the mix of industries. That requires deeper digging. But the headline occupancy is definitely a positive sign.
And that RM 4.5 million on enhancements, that ties into keeping those tenants happy and the assets valuable, right? Like planned maintenance.
Absolutely. It's proactive. Spending that money suggests they're not just letting things run down, but actively maintaining and improving quality. That aligns perfectly with ensuring long-term value and competitiveness, which is exactly what you want to see.
Sustainability, ESG, becoming huge for investors. Any hints in this report?
Not explicitly detailed in this quarterly financial update, but you could argue that investing in enhancements could include ESG elements like energy efficiency upgrades. REITs are increasingly integrating this, but you'd likely find more detail in their annual reports or specific sustainability reports rather than the quarterly financials.
Okay. And the big picture stuff, interest rates, the economy, how might those headwinds affect AXIS REIT?
Well, the fact their financing costs actually decreased this quarter was a definite plus. Maybe they locked in some good rates previously.
But future hikes could still bite.
Potentially, yes, especially if they need new financing for acquisitions or developments. And of course, a broader economic slowdown could eventually impact demand for space, even industrial, or just dampen investor sentiment towards REITs in general. Always factors to watch.
Okay, so let's try and wrap this up. Key takeaways from AXIS REIT's first quarter.
I'd say it was a pretty strong start to 2025. You saw solid growth in income, NPI, EPU, and importantly, that DPU, the dividend.
Yeah, the dividend jump was notable.
Very healthy occupancy rates, too, and they're actively investing back into the properties. Seems like solid operational performance.
And looking ahead, what should listeners keep an eye on?
Definitely track the progress of that Bukit Raja acquisition and the annex disposal. Keep watching financing costs, especially if interest rates move.
Yeah.
And just, stay aware of the overall economic climate and how it might affect demand or sentiment.
So the final question for you, the listener, really builds on all this.
Yeah.
Given AXIS REIT's solid Q1, their focus on industrials, their active management, how do you weigh its potential for continued stable returns against that always changing economic picture?
Yeah, that's the core question for anyone considering it as part of their investment strategy.
Definitely something to mull over. Thanks for joining us for this deep dive into AXIS REIT's latest results.